What are order blocks in ICT trading? How do you identify order blocks on your chart and trade them? How do you maximize returns from order blocks? What time frames should order blocks be traded on? Are there any free indicators to automatically detect order blocks on any chart? I will answer all these questions in this video. I will also show you many samples from the recent price actions, so you never forget order blocks for the rest of your trading career. Let's begin. If you want to be a winning trader, you must trade with banks and other financial institutions, including hedge funds. In other words, you must trade with smart money. That is what ICT, or the inner circle trader, teaches us. Then, if you want to trade with smart money, you must know order blocks. You must know when they buy and sell. They are market makers and trendsetters. They upgrade or downgrade assets. They are engaged in valuation, influencing public sentiment by reaching out to the media. If you want to increase your win rates, or I should say, if you want to survive as a trader in the financial market, you must trade with institutions or smart money. There is no other way. ICT's order blocks are so important that you will suffer if you want to be clever with them or disregard them. Imagine a situation where the entire market is rising. Millions of dollars are pouring into the market every moment, and you, sitting at your trading platform, short the market. Why do you think the market will reverse the moment you short it? Why do you think a falling market will reverse the moment you take a long position? It does not work like that. The moment you accept that you are a retail trader with a limited amount of money at your disposal and you cannot influence the market, not at the scale institutional traders can, trading becomes easier. Next time you sit before your trading chart and place a trade, remember this very truth. Wait before making a trade, whether long or short. Try to understand the chart intimately. Do you understand what each candlestick means to you? Do you know what constitutes the market structure? A lot of secrets are laid bare before your eyes. You just have to know how to utilize them. ICT order blocks are specific price points or price ranges where smart money or institutional traders place their orders, both buy and sell, and influence the market of an asset. Let me simplify this for you for the rest of your trading life. A fund wants to invest $100 million in a stock. They want to enter the market at $100 per share. They place a cluster of orders at $100, but the available sellers or liquidity at $100 are smaller than $100 million. They may have $20 million of orders fulfilled before all the liquidity at $100 is exhausted, and the price goes up to $101 or more. The rest of the orders, that is $80 million worth of orders, are still open. However, the fund is not ready to fulfill those orders at any price above the $100 price level. They will wait for the market to return to the $100 level. When the market returns, the remaining orders are triggered, and again, the price goes up. This situation continues until all the $100 million buy orders are fulfilled. Now imagine what can happen when other big players also want to fill their multi-million dollar orders at the same $100 level. The market will bounce from that price the moment it gets there. If you know that the $100 price level is of great interest to institutional traders, wouldn't it be easier for you to make money by buying an asset at that price and letting its value rise as an effect of smart money decisions? On the other hand, if all sell orders are absorbed by institutional orders at $100 level and you also go long at $100, the market cannot fall below $100 to cause you a loss. The sell orders cannot overtake the market, which means the market will remain bullish. How beautiful would that be for you as a trader if an asset's price does not hit your stop loss? Let us look at the situation from a different perspective. Nvidia has been one of the finest stocks over the last 2 years for traders. I know of many traders who do not trade anything else but Nvidia. They trade it as a stock and they trade it as options, but they follow the same order block strategy to gain from the market. In this scenario, we have a huge smart money fund that believes that the $100 price level is the best entry price for Nvidia. They take a position of 100 million shares at that price. $1 below that price will cause them a loss of $100 million. Do they want to lose that amount of money? What if Nvidia falls to $95? They will lose $500 million. Institutions do not work like that. They want to protect their asset at any cost. They have backups. As the price of Nvidia approaches $100, they engage more funds to keep the price above that level. That means they put a big number of limit buy orders which are triggered as soon as the price hits the $100 mark and push it upward. In both cases, you have a support at $100 level. In the same way, smart money also decides a price level or range where they want to exit the market or short an asset. If they decide to sell an asset at, say, $125 and place sell orders worth millions of dollars at that price, and you want to go long at $125, you have no chance of winning your trade. The market will fall below $125 looking for buyers, or what the ICT calls liquidity, thus hitting your stop loss and taking you out of the market. Prices may return to $125 again, and again they must come down because they will only trigger the endless institutional sell orders there. That is how the $125 level becomes a resistance. Now, how to identify order blocks on your chart? Technically speaking, if you want to go long, your order block is the last red candle or blocks of red candles that trigger the bullish trend. On the contrary, if you are a short seller, your order block is the last green candle or blocks of green candles that trigger the bearish trend. A clear example can be found in this image. This is Nasdaq 100 E-mini futures. It is an hourly chart. Here, you can see 2 order blocks. The top one is a bearish order block, which has become a resistance. The bottom one is a bullish order block, which has become a support. Notice that the bearish order block originates from a green candle, and the bullish order block originates from a red candle. Also, notice that the price range or market structure represented by the bearish order block green candle is broken by the red candles after that. This is not the same as the small green candle before that. The small green candle is followed by another green candle, therefore it does not become an order block. The green candle before the small red candle also does not become an order block because the red candle does not break the structure represented by the green candle at the bottom, thus falling short of triggering a downward trend. Similarly, the long red candle becomes an order block because after it, the bullish trend begins. It is the last red candle, but the 2 green candles after it broke the price range or market structure it represents, which is not true about the red candle before it. That small red candle was followed by a second red candle, not a green candle. That means it only continued the bearish trend. In this image of Bitcoin futures, we see 2 bullish order blocks. Notice that both of them started with red candles and broke the prior structure to begin a bullish trend. In this image of gold futures, we see 2 order blocks. The first is carried from a previous market structure, and the second one is from the recent market structure. See that it originates from the last green candle. The red candle broke the market structure represented by it and began a downward trend or a bearish market structure. It has become a resistance, which is why the market rose very close to it, but retreated even after making 3 or 4 attempts. If you are interested in order blocks, you may also be interested in the ICT Silver Bullet strategy. We have posted a video on ICT Silver Bullet recently. You can watch it by following the link in the description below. Once all conditions are met, the Silver Bullet strategy offers you high probability trading setups. Like order blocks, it focuses on institutional trading patterns and market inefficiencies. It can help you become a profitable trader. Follow the link and check it out. This is E-mini Russell 2000 Index Futures. Here we see 4 order blocks. The bottom one is carried from a previous structure. It is a bullish order block. It is working as a support. Because of that, the price has bounced off it. In the upper half of the image, we have 2 deep order blocks and 1 shallow order block. All 3 originate from green candles. The red candles after the green candles broke the structure and created a downward price movement. The tiny order block may be tiny, but notice that the red candle after it broke its bullish price level and created a new structure for the market. Generally, order blocks are found at reversal points, breakouts, higher highs, higher lows, lower lows, liquidity zones, the previous day's high, the previous day's low, the previous week's high, the previous week's low, and at extreme ends of market structures that can be within a bigger market structure. Now, I will show you some samples from the live market to familiarize you with order blocks. In these samples, you will see both bullish and bearish order blocks. Notice that they are so vivid, so easily identifiable, and they mean so much when it comes to understanding price movements. These days, you don't need to identify your order blocks manually. You can use an order block indicator on your TradingView chart to understand the market before placing a trade order on your trading platform. Open a free account with TradingView so that you can save your chart and indicator setups. All the images of order blocks I have shown you during this video are taken from TradingView. I used 3 indicators: Order Block Detector and Order Blocks and Breaker Blocks by Lux Algo and Order Blocks by Mark Middleton 2020. There are many more order block indicators on TradingView. Choose the one you like and trade accordingly. In this chart, I am trading natural gas futures by using order blocks. I am short one contract, and at the moment, I am $110 up. How to trade order blocks. Order blocks become order blocks when the price breaks the structure. That means the price has already moved away from your entry point. But according to ICT, the price will return to the order block at least 70% of cases. It is then that you will enter the market. You will take a position if the price returns to the entry point. If it does not, you do not have a position. You lose nothing. Move to the next asset, next stock, next forex pair, cryptocurrency, or index future. Trading order blocks is very easy. For long trades, place a limit order at the top edge of the bullish order block with a stop-loss order under the order block. Your profit target will be the buy-side liquidity zone above the closest swing high or market structure. Wait for the market to return to your entry price to trigger the limit buy. Have patience. Order blocks offer high probability setups. You need to wait patiently to have such a high probability setup. For shorting, place a limit sell order at the bottom edge of the bearish order block, with a stop loss right above the top edge of the order block. Your profit target is the sell side liquidity zone below the closest swing low or market structure. Based on the time frame you use, your profit target will vary. I recommend that you use a 4-hour chart to determine your market structure and then find an order block to pinpoint your entry point on the 15-minute chart. If you trade 5-minute charts, find your market structure on the hourly chart and an order block on the 5-minute chart to determine an optimal entry point. If you trade 4-hour charts and use the order blocks on that time frame, your stop loss may be very high. If the market swings against you, you will sustain a massive loss. Always use a smaller time frame to enter or exit the market. If you can identify the market trend from the higher time frame, you may make several entries within the same market structure. This is natural gas futures. It is a 15-minute chart. Notice that the market has offered you 3 high-probability setups within a few hours' time. Also notice that the market has obeyed the order blocks as resistances. The price did not cross the blocks to hit your stop losses. You can utilize the order blocks within the market structure to re-enter the market to exploit the market's weakness in your favor. But make sure that you consider every order block individually. Place a stop loss above the order block for the trade related to the order block. In this case, you will sell the market. How to optimize your risk-reward ratio in order blocks. You may have noticed that there is a line right in the middle of the order block. You will see this line if you use the order block detector indicator. This line is called mean threshold. As we said above, the price will return to the order block to fill your order. If you place a limit order at the edge of the order block, you have the highest chance of having your order filled. But sometimes the price reverses before touching the order block, thus depriving you of a high probability trade. However, in some cases, as you see in this image, the price not only touches the edge of the order block, but also penetrates it to rise above the mean threshold. Wouldn't it be better to have your order filled at the mean threshold instead of at the edge? You will have a higher risk-reward ratio since your stop loss is now smaller and your profit target bigger. It is difficult to say under which circumstances the price will reach the mean threshold to offer you such a finer entry. ICT is quiet in this regard. Price action is quiet. I have not seen any solution to this personally. That is why I place 2 limit orders when I trade, with my stop loss at the same price point. One of these orders is at the edge of the order block and the other at the mean threshold. If the price fills the order at the edge, that is fine, but if it touches the mean threshold, that is better for me. If ultimately the price crosses the order block becomes a breaker block. My stop losses will be triggered. I will not cry, because the second trade will cost me only a minimum amount. Another thing I do to maximize my profit is reposition my stop loss. Generally, I bring my stop loss to break even as soon as my trade is in a profit equal to my risk. But to lock in the maximum profit, I reposition my stop loss below every new order block through to the liquidity zone or profit target, as you can see in this image. If the market reverses, it will not wipe out all the gains I have made. This also helps me to hold on to my position as long as the market rises, provided I am long. I become really happy if the price rises through a resistance or liquidity zone and turns it into a support. In that case, I am in the trade until the market takes me out. This image shows that the price has passed through 3 order blocks and turned all 3 of them into support blocks. The S&P 500 E-mini had so much momentum in it that it demolished 2 long-established resistances and 1 new resistance. In such a situation, repositioning your stop loss may bring you an excellent result. Make the best use of the trade you are in. Who could tell? Maybe your next trade will be a loser. Maximize your profit when you are in a winning trade. Do not cut your winners short. If you have been losing money constantly, you may be tempted to get out of your position with a small profit. But that is a mistake. If you take a small profit when you are in a winning trade, you will never make it as a trader, because you will not exit the market until your losing trades hit your stop losses. That means your losses will be realized 100%, whereas your gains will be realized only partially. Believe me when I say you can create a trading career centering around order blocks. Order blocks tell you everything that you need to know to become a profitable trader. They give you a clear picture of the price movement. They tell you where the supply is high and where the demand is high, so that you know where to sell and where to buy. They also tell you what the big money or the smart money expects from a certain market. Institutions are in the know. They have the resources to research an asset, determine its value, and influence its course, be it stocks, crypto, indexes, or forex, which retail investors like you and I do not have. They are after big money. Follow their footprints by obeying order blocks. You will win more trades and earn big.